Let's get across the market open now. Scott Phillips joining us in the Motley Fool. Scott, happy Friday to you as reporting season, of course, continues. A number of results out today. Just let's look back perhaps what we've seen this week with a focus on the retailers, also the big miners. What's your takeout been?
Mate, two big themes, right? So great way to start. Retail's fascinating because we've seen a real mixed bag. And, you know, Meyer a couple of weeks ago said, oh, look, things are tough, but it's all about the discretionary retail environment. JB Hi-Fi had a very good fiscal 26, but a very soft July. Those shares were smashed. Then Super Retail Group out yesterday. The results decent. I should own shares in Super Retail, by the way. Reasonably decent, but a big jump in the share price. That was largely because the market expected worse. So you've really got this combined kind of, you know, sentiment versus reality, and then trying to work out how much of the reality is genuinely underpinned by the discretionary retail environment, and how much is execution, and how much is offering, and that kind of stuff. I thought the JB Hi-Fi numbers were pretty decent for the year, a little ordinary for July, but it's only a month, so you go, okay, fine, that's okay. Super Retail, particularly Rebel, the World Cup helped them with merchandise sales, so is the market getting too excited about that? Maybe. The bounce back, you know, when things move by 15 and 20%, mate, remember what the market's saying, implying, is we think the future earnings from now until eternity, discounted back, I know it's Friday morning, but stick with me for the very quick math lesson, discounted back to today, is 15 or 20% lower. Every dollar I thought they were going to earn yesterday afternoon, this morning, I now think $1 in $5 I expected from that business from now till forever is now gone. And so those big moves are very, very rarely justified. If they are structural, permanent changes, even then, is the size really that big? Probably not in most cases, but that's what we see with the market. So JB Hi-Fi got smashed, probably because the market was a little too excited in the first instance about what JB Hi-Fi could do in a tough discretionary environment. So that's probably some sort of right size. Even as a Super Retail shareholder, though, I don't think it was worth a 15% jump on the news they put out. So you've got a lot moving around, mate, a lot in that space. I don't know yet what to think about what's happening for discretionary retail overall. The trend does seem to be down. If you back out Super Retail's benefit from the sports merchandise in the back of the World Cup, maybe that's a slightly less impressive number. Macpac sales were down. They blame the weather for that one, and maybe that's true too. But yeah, it does seem like a harder, tougher consumer discretionary environment, and no surprise for all the economic reasons we know. But overall, not every retailer being tarred with the same brush.
Also in the consumer discretionary space, Guzman y Gomez out this morning too, Scott.
Yeah.
Look, it's copped a hit from its US exit. But actually, given that, what do you see as its growth potential, given now it's limited to this part of the world?
So as always, mate, you got to compare the business with the price. And I say all the time, we should be business analysts first and then investment analysts, right? And I know it's the same thing, but it's business first, price second. And the market just got stupidly carried away. Anyone who's been to the US and seen Tex-Mex over there, I think, so here's the thing, Guzman should have tried to do it, because why wouldn't you? Maybe they make it successful and you go, wow, the odds were low, but they made it. So, of course, you go and spend some money. And yes, it costs shareholders money if you don't do it well. But we pay management to take calculated risks to try and maximise the value of our investments. And so, of course, they should have tried it. Low probability bet. I'm really impressed. I don't own shares. I'm really impressed with management for shutting this one down. Really, honestly, mate. They went, this isn't working, we're going home. They could have said this, oh, we'll try again, we'll try again, we'll try again. And it's ego and all the promises they made to shareholders, share prices. Every incentive is to kick the can down the road. They did the right thing and said, no, we're going home. I like Guzman as a business, mate. I really like the Australian business. I was never comfortable with the prices that people were paying because they were expecting the US expansion would succeed. And I thought that was always, frankly, way too rich for my blood. I love the business. I'd happily buy it. I really want to buy it at a good price. So growth locally, they're saying 35 to 40 stores a year in the medium term. So that still seems pretty impressive in terms of growth. Same store sales growth looks pretty good. Profit growth is excellent. So they're doing everything they can and should be doing. I'll put the old glass dogs under them these days, mate. Sales up 17.9%, underlying NPAT up 30%, EPS per share 34%. So, I mean, really, you can't ask for any more than what they've done. The question, of course, is the share price. Yeah, does the share price justify that level of growth or more than that? Or does it require more than that? The answer is, of course, in the past, it did require more than that. So I love it. I love the business. I think the growth is really great. It's a high quality company. You'd be happy running it. Do you want to pay today's price? No, I don't. I don't know that's necessarily the price you want to pay just yet. Still trading on triple digit PE. Even if you allow for that growth that they've just handed down, maybe that falls to very, very high double digit PEs. It's not a reasonable price for effectively what is now an Australasian growth story. So I love the company, want to buy it at a good price. This is not that price.
Scott, elsewhere in the resources space, we had the biggies this week, BHP. Fortescue also. A real distinction here, isn't there? Because obviously Fortescue's business is only iron ore, whereas BHP has become that diversified miner, now very much about copper.
Yeah, absolutely. I own some shares in Fortescue, mate. Not many, but I own a few, so full disclosure there as well. I thought Fortescue's numbers were pretty good. The market wasn't particularly enthused by it. Here's the thing with most of these miners. You kind of get most of the story on the way through. We know the daily price of commodities. We know most of what they've hedged. We know most of their operational numbers because they release those quarterly. So by the time you get to earnings, you kind of have already got the building blocks you need to put together what's likely to happen. So absent any particular cost overruns or things that weren't reported earlier, you kind of know what to expect. So Fortescue, I thought was a pretty decent result. You're right, iron ore only. In the past, it's been a spectacular thing to be because iron ore has been on an incredible run. But things have moved really, really quickly. And copper, as you say, is where it's at for BHP. Now, that copper price up 35% over the year. That is a remarkable growth. And if you're particularly bullish on copper, you say this is here to stay, it's going to be forever. Those of us who've been around a bit longer say there's usually a supply response. It might take a while, but it's there. So really the question for investors right now is, are you prepared to bake in a permanently higher copper price or a copper price that goes higher from here? And as I say, remember, the lithium story rings true for everybody. So hopefully we've learned our lessons from that one. Even if you're right about the demand side, it is the supply side and the combination you need to really allow for. We're working out the realised price of these commodities. So I think copper is going to be huge, mate. Well, we know electrification is going to continue to be huge. It's funny, we talk about batteries, it's all about lithium. Now it's electrification, it's all about copper. Those two trends have been ongoing and will continue to grow. The real bet you have to make is, what will the supply response be? How big, how quickly, how well will it pace or overtake demand growth? We know in lithium the answer was supply overwhelmed demand growth. Of course, it's gone backwards again, or gone back up again since. But that's kind of the question you need to ask yourself. BHP's result was very good. You can't, I mean, what, 14 billion US dollars? It is absolutely a very, very good result. Whether or not it can be sustained at that growth level or even that price level, that is something we're going to have to keep a very close eye on over the next 12 months.
Scott, yesterday we also got IDP Education. Goodness, it was smashed. Those student placement volumes certainly taking a tumble.
And kind of deserve to, Andrew. I don't do victory laps because I think it's arrogant and we all make mistakes and I'll get plenty of stuff wrong as well as right. So I'm not going to do that. But I will say that on IDP Education, the tide was all the way in. I mean, student numbers were massive right around the English-speaking world. It's what they do there is student testing and education. The price that the market was asking for those shares, they've extrapolated past growth. When I say the tide was already in, placement numbers were huge, unis were full, international student numbers were high. And then you could see frankly, it's light at the end of the tunnel was definitely a train coming the other way. We know politically, and again, I put aside the actual political views, but there was pressure on international students in Canada, in Australia. We know these things have been coming at us. So it's no surprise that student volumes are down. It really should have been one of those things we expected and, if not knew, at least had a very high probability of happening. So the issue isn't IDP itself. Again, it can only operate in the market that it's in, as long as it maximises its potential given the settings that it's got. As a business, it's running perfectly fine. Now, I'm not saying it's great that things are down, but if you're maximising the opportunity you have and the opportunity shrinks, then a bit like resources, right? What do? You get out of the ground as cheaply as you can, you keep the incident and accident levels low, and you sell as much of it as you can, let price do its thing. In the IDP Education case, it's the regulatory and legislative changes around student numbers that it has to deal with. It can't control that. So it's done as well as it could. But I honestly think the market's at fault here for somehow believing that this wouldn't be a problem, that it would be something that could somehow magically be turned around. So, no guarantees. I didn't see it with perfect foresight, but it was always very rich for my blood, given that potential and frankly kind of actual, we knew they were happening. So, yeah, I mean, if you hold the shares, my apologies. I'm not trying to dance on your financial grave here, but the simple reality is that situation, they did what they could with what they had. And the profit numbers really weren't particularly surprising to me. What investors now need to work out is, does the tide go back in again or does it stay out? And that's a gutsy call given what's happening right around the world, I think. So I don't suspect there's a particularly quick, it might be. I don't expect there's a particularly quick bounce back in student numbers. There's probably not a particularly large bounce back in education and training. In that case, IDP, there's probably a newish normal or normal-ish, maybe, better way to put it, which has it not being able to grow at past rates for a while to come.